Good morning. How are you all? Juan Rodriguez, editor of ImpassiveWealth.com. In this video, I want to do a practical demo of, it's just an example, but it will tell you how to use an investment platform and how to design your own saving plan based on somebody's. I do investments for this very close to me person once a month. So I would like you to see how I do it. It doesn't mean you have to do the same, but it might provide you some ideas. Okay? And I would like to start, this video is focused quite a bit on the United Kingdom, where I live. And a few details are pertinent before we start. So let's start the getting into the details now. Okay, ImpassiveWealth.com, most of the content is in Spanish. Here we have our YouTube channel. You can subscribe to it, and if you speak Spanish, you can listen to all videos. If you only speak English, you can just watch the videos in English. Okay, let's first thing, as a small saver that you need to bear in mind is in the UK we are extremely lucky with the taxation of the profits of saving. So we have ISAs, individual savings accounts, and we have SIPs, excuse me, self-invested personal pensions. Both have phenomenal tax advantages. They are, I would say, unique in the world. Other countries have similar things, but not the same. Okay, so an ISA basically shelters your profits on anything you invest from tax. Some people tell me, oh, ISAs are not worth, the profit is interest is very low. Well, this is the case for cash ISAs, but we are talking about stocks and funds ISAs, where you can invest in a vast amount of different assets. That's the one we use. Our favorite asset class is stocks. On ISAs, you can shelter 20-something thousand pounds. I mean, I think this page is actually not up to date. There are lots. You search on Google for ISA and you get a lot of. Okay, with ISAs, you put your money in, you invest it. After the years, remember, invest for the long term. After the years, you get profits, you get dividends. All of that is taxed at 0%, i.e., not taxed. Okay, you can take your money out at any time. So what's not to like? In an emergency, you can get hold of your money. Okay, SIPs are a different thing altogether. SIPs are designed for pensions. So first thing, you get tax relief at the moment you invest. Or in other words, if you invest, put in money from your own pocket, you get like your marginal tax rate of relief. You get an extra 20%. The government puts in another 20%. So you get, for starters, you get a juicy bonus. Okay. Now the problem with SIPs is several problems. ISAs have their own problems as well, but both are fantastic products. With ISAs, you get tax relief when you get your profits after the years. With SIPs, you get your tax relief at the start, and then you are taxed when you draw your pension. You cannot touch your money until age 55. That is a disadvantage because, in an emergency, you cannot take the money out, but it's an advantage in the sense you cannot touch the money, so it's going to be there for the long term, you like it or not. At age 55, you can take out 1/3 tax-free. Again, another disadvantage is, you are 20-something. By the time you are 55, the law might have changed. You might not have the advantage you have now, although the authorities in the UK tend not to legislate, so people are, taken for a ride because they signed up 20 years ago to something. Other countries do that, and you start something with some conditions and they change them, and it applies to you retrospectively. Okay, but from now to where you will get your pension, the rules might have changed, so that's something to bear in mind. My personal view, both instruments are very good, serve different purposes, and perhaps you might consider having both. Okay, and that decision has to be driven by your needs for cash, your life in general, your lifestyle, how much in the SIPP, how much in the ISA. If in doubt, get an ISA. Okay, but the SIPP is useful. The not touching the money is actually probably more of an advantage, unless you really hit a real problem when you need to get hold of the money. Okay, now, so I'm going to show you, let me just log in, a practical example of, a savings plan inside an ISA for somebody of my family very close to me. Okay, so here I am sharing my screen. This is the environment of Charles Stanley. It's an investment platform. You open an account online and you manage it, as you are going to see in a minute. This is the portfolio of a young person that has been saving for a while, lump sums and bits and bobs, and she's putting a bit of money in the account every month. So for instance, if we go here to view transactions on the statement, we are going to see a few things. And this £150 is what this person is saving every month. The platform fee, you get a fee for having this account with Charles Stanley. Hargreaves Lansdown is very good. It's a bit more expensive. I use Charles Stanley because it's cheaper. There are more, Fidelity, AJ, Bell. It's good that you compare them before you decide who to go with, and all of them work in a similar way. Charles Stanley used to be a lot worse than Hargreaves Lansdown. Still, the difference in cost, well, they hacked the cost, so they are closer now. But they made a vast improvement. The interface you are seeing now is an improved version of what they have, which was a lot more. So each month, £150 come in. The cost of the platform is £2.12 for this almost 10 grand inside the account. It's a percentage of the value of your investments. And then every month there are 2 investments of £100 into particular funds. And we go to that straight away. So if we come back here and we go to my holdings. Okay, the strategy for investment for this person is very simple. Okay, we have these 6 assets. Okay, they are, except these gold funds, there is not a cheap tracking gold fund, and this is a good quality active fund. It's more expensive than a tracker fund, but besides gold, The other are trackers. They are super cheap. Some of them are extremely cheap. If we go to this one, we go to the, you see, total ongoing charges 0.07%, which is outrageous. So pick your investment, your funds wisely. We have 6 now, which is about right for 10 grand. When you start, if you have just you know, maybe 1,000, there is a minimum you can invest on each. I think that minimum is around 1,000. So we have 6 here. If you have 1,200, you might be forced to have only one, and then split that one as your money grows. So you get to 3 grand, then have 2, and then 4. In this case, we have emerging markets. Vanguard has a lot of very cheap investment funds. So we have one for emerging markets. We have one for the Pacific region, excluding Japan. You can include Japan, but Japan tends to have a big weight. So this is the one I picked here. This SRI European is Europe including the UK. So we kill these 2 birds with 1 stone. Again, you can have a European and then a British. You know, doing the asset allocation is your call. Excuse me. We can give you some ideas. The one I showed before that is so cheap is an American index. So American stock markets. This one is a bit to mix things up. It's a global small companies index. Okay, just to put small companies into the mix. Emerging markets covers, you know, China, Southeast Asia, India, Latin America, those sort of places. So we have these 6. So what is our strategy? Our strategy is simple. Have equal parts of the portfolio in each of these funds. Okay, we have some money in cash here. We are putting in 150. We are investing every month 200. So at some point that money is going to be, you know, exhausted. But this way we invest periodically, and you know, if there is a market crash, our money buys more units. It's a bit of compensating volatility, have a bit of peace of mind. Strictly speaking, in most cases, you are better off investing the lot and then investing the 150 every month. But I chose to do it this way and comfortable with it. And, you know, I don't want this person to see on television, you know, the markets are falling and, you know, how much do I have, and start, you know, the panic game and so on. We are here for the long term, and most funds are in the green. You know, I don't pay a lot of attention to, you know, obsess with coming in every 2 days, you know, take a look at these figures. I just keep the mechanics every 15th of the month. Today is the 16th, but every 15th of the month, I take the 2 funds with less market value and I put 100 into each of them. So if I sort by market value, so I'm sorting from biggest market value 1351 to the lowest market value. So these 2, by a few pounds really, but these 2, and I do it mechanically, I don't think too much about it. These 2 take the 100s this month. So the gold fund, you know, go to actions, buy, and the small caps is the next one. So that is 100. 100, do the relevant clicks here, you know, password. Go to the confirmation. Let me move this over here. Okay, this is just to check. Okay, so it's the gold fund, blah, blah, place this order. Okay, so that is the confirmation of the order. We return to our accounts. We go again to the portfolio page, and the next one was the small caps. Okay, so small caps by another 100, and just the same process. So this is what I do with this account. You can do something else. You can put 100 in and invest the 100. You can put a lump sum and do a bit what I'm doing, keep some money in cash and drip feed it. A little something I want to tell you. Okay, let's get this out of the way. Again, confirmation, global small caps. Okay, place this order. And now I can go to the order list just to see that the orders went through. Okay, so these two orders are now sent. With investment funds, you don't buy the assets there and then immediately. It takes 1-2 days. So the price is going to be slightly different to what it is now. With ETFs are funds that behave a bit like shares. When the market is open, you buy there and then at your chosen, well, not chosen, but at the price of the time. Okay, but I would do investment funds. They don't cost anything to buy. These two operations are free. What Charles Stanley charges is the 2-point-something pounds per month, as we saw before. ETFs and shares have a £12 per operation, and then there is some stamp duty or something. So small savings, keep it simple, don't. So this is what I do for this account of, somebody close to me. As you see, is very simple. Yes, something important. If your money reaches, 30 grand, that sort of thing, then the 100 a month or the 200 a month is going to be a minuscule, portion of the value of your portfolio. In that case, you might need to do rebalancing, like once a year, sell and buy, so the percentages. In this case, is 1/6 per fund. Probably with 30 grand, you might have up to 8 or 10. Let's say 10. So each of them is 10%. If one of them is 13% sell, and the other one would be 8% buy. So they are all 10% once a year. But with the monthly subscription, the monthly saving, you can go to the one whose value is the least of all and keep rebalancing every month using that. Next step, if you have 50 grand to 100 grand or more, at impassivewealth.com, we have developed an algorithm that manages the cash and funds inside your portfolio, and every month it provides a list of orders. Many months there is no orders at all. And well, for a small fee, we can provide that service, which is like a newsletter. By the way, all of this is not financial advice of any sort. If you decide to implement some of this, you do it at your own risk, do your research, talk to an advisor if you need to. So, just to be clear, investments can go up and down, all of that, okay? In the very long term, they tend to go up, and that's the hope, of every investor. Anyway, So let's get rid of this. A last thing is, here is a list of cheap investment funds. Again, the gold is an exception. I do this to manage my own other accounts, which are bigger and I have more of these assets. And, you know, again, small companies, British small companies, gold, property, natural resources. These are decorrelated with the main markets. Well, the smaller companies probably not, but you know, gold and property and natural resources have life of their own. And then you have your classic big capitalization funds, American, emerging markets, another one for small caps, but global, not just British, Pacific, without Japan, European. We saw it before. Some of these overlap with the portfolio we just saw in Charles Stanley. And then we have another couple of American and European. These are used for a technique I use in my other accounts called momentum investment. And the last one is corporate bonds. You know, look at the corporate bond. It's 55, 56 all the time since, you know, 2017. But it's a nice fun to park money when, you know, the momentum is not using shares. But that's another video. So this, you know, and if you click in one of them, I mean, this Vanguard emerging markets, you see the, you know, the Morningstar page for the fund, and, you know, ongoing charts 0.27 for emerging markets, which are more expensive to replicate. So all of these, except for gold and probably for commodities, are cheap funds, passive indexed funds. And that's what I do. If you want this list, this spreadsheet with all these links, and again, this is not a recommendation, this is just an idea. Hargreaves Lansdown have a section dedicated to index funds, and you can search on the internet. There's plenty of information, so you can find, but you know, it's diversification, long-term, periodic savings. Those are the keys for modest saver and investors, you know, wealth. You know, go slowly, don't panic, don't change your plan, keep going, and then at some point you will have nice profits. And the tax advantages are huge. In the UK, my customers and friends in Spain desperate when I talk about ISAs and SIPs, because, you know, the environment there is a lot more aggressive in terms of taxation. Okay, enough. Too long this video as usual. So just to say goodbye. Thank you very much for your time. Thank you for watching this video, and well, I'll see you soon in the YouTube channel. Please, there will be a logo somewhere around here. Please click on it to subscribe to the channel. If you subscribe, you help us do more videos and have a bigger audience. So, you know, please, 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 if you can, and then you don't miss any videos. And if you cannot watch the video that week, then don't worry, don't watch it and wait for the next one. Thank you. See you all soon.